It is very hard to find anything that's still worth investing in. Bitcoin is above its average cost basis. Property has very low rental yields. The price to earnings ratios of stocks is incredibly high. Gold relative to the money supply is also very high. So what can we really do if we want to make a contrarian bet? Is there still something that we can buy that's currently not overvalued? I've got a potential idea, but it is controversial. But let's first have a look at the overall situation. There's a case to be made that Bitcoin is not historically cheap right now. This is the CBBI. It's an aggregate index of all kinds of very useful indicators that used to work pretty well in the past. When we combine all of those indicators, we are far away from cheap. As in, whenever we are between 0 and 20, it was a good time to buy. But currently, we are at a value of 66. So clearly, Bitcoin definitely has quite a bit of risk. It can potentially go down quite a lot. How much? Maybe we go again below the realized price, the average cost basis, which currently is at 56K. In the past, at the end of a bear market, we always went below that average cost basis. And the reason why Bitcoin is struggling that much is because the OGs, the very early investors in Bitcoin, they are selling more and more. So over here we see the whale shadows. The Bitcoin that hasn't moved for the last 10 years starts to move again. The Bitcoin that hasn't moved for 7 to 9 years also is getting sold off more and more. Also for the medium-term Bitcoin, say the ones that have been held for 5 to 7 years, we are seeing now much more selling than we used to. It's the same across the board. It's the same across all of the longer term holders. Bitcoin is getting sold and there is quite a bit of potential for it to further go down. So Bitcoin is a risky bet. Unfortunately, the stock market isn't cheap either. This is the historical price to earnings ratio, right? Whenever we buy a stock, we are essentially buying the future earnings of a company. This chart is extremely long in duration. It starts in 1971. The current PE ratio is very close to where it had been at the peak of the dot-com bubble. Then the dot-com bubble burst and subsequently we had the global financial crisis. And it's very hard to make the argument that stocks are a steal right now. Also, stocks relative to the money supply are very expensive. Very close again to the height of the dot-com bubble, with a potential to go down by roughly 50% if we hit the long-term equilibrium. So this chart starts in 1959. It shows the S&P 500 relative to the money supply. Tech stocks might be even more problematic. This is the Nasdaq 100 relative to the S&P 500. Again, this is the dot-com crash, and we're even now higher, relatively speaking, compared to the peak of dot-com. So Bitcoin is risky, stocks are risky, especially tech stocks. What about gold though? Because fundamentally the idea is that gold is a hedge against those risk on assets, right? Whenever risk on is contracting, whenever people are scared, they might be moving to gold. Now here's the long-term gold chart relative to the monetary base. The chart starts in 1959, and while we did see a turnaround in the past at the current price level, it seems like there is still some more upside, right? Maybe gold can go up by another 140, maybe even 150%. But here's the problem. This chart assumes that there is a constant ratio of the money supply versus gold. But unfortunately, the supply of gold is also increasing over time. There is gold mining, and the gold supply grows by roughly 2% per year. So really, we should expect the gold price to decline versus the monetary supply by 2% per year. From this data point here, right, 1980 to today, we've got 45 years. Now, if we compound a 2% over the course of 45 years, we have a loss of 60%, or we've got 40% left. Now, let's measure those 2 points. From 1980 to today, the price declined by 59%. So if we were to compare the gold market cap relative to the money supply, not just the gold price, then those two peaks would align perfectly. And the current peak we have in gold could lead to a similar contraction of purchasing power, as has happened from 1980 to the 2000s, which was a decline of 89%. In other words, gold at the current level is not very cheap either. It's also risky. Bitcoin is risky, stocks are risky, gold is very expensive as well relative to the money supply. Now, I probably don't have to talk about property. We all know that property tends to have very low rental yields as well, especially in the city centers. So what's the alternative? What's the potential contrarian bet? Now, because it's a contrarian bet, it will be very controversial. The vast majority of people watching this video are going to disagree. But that's the idea of a contrarian bet, right? We buy the thing that most people do not want to buy. And here is that depressed asset. It's long-term government bonds. This is a long-term government bond ETF. It's called TLT. And at the bottom, we see the Fed funds rate. Whenever interest rates fall, prices of long-term government bonds go up. It happened over here in 2007 and 2008. It also happened over here in 2019, 2020. I don't really like doing it, but that's how the YouTube game works. That's how the algorithm works. Please give this video a like if what you've seen so far has been useful. Thank you very much. Currently, we are again in a period of monetary expansion. Interest rates are coming down. And so far, long-term government bonds have not appreciated. They are still low. And that's the potential opportunity. Now, why have they not appreciated yet? And how much upside potential is there really? Because those price appreciations might not be that interesting, right? 50% here and 35% over here. Now, there is a way to lever this up. So instead of buying the TLT long-term government bond ETF, we can buy TMF, which is 3 times levered. Now that 35% rally suddenly is a 117% rally. But of course, leverage goes both directions. If long-term governments fall, then TLT goes down only by 51%, while TMF is going down by 92%. Now again, why does TMF not go up when interest rates are coming down? The answer is the term premium is going up. In other words, the risk premium people put on longer term government bonds. Investors are more worried, relatively speaking, about the solvency of the US long term. That's an effect that has been going on for a while, but we aren't necessarily at historically high term premiums. In the past, we did see contractions from the current level, which would, of course, support long-term government bond prices again. If this is going down, this is great for our bond prices. Now, how much of a problem is the debt to GDP ratio in the US really? Will the world really not buy US government bonds in case we suddenly see a crash? Let's say the AI bubble was to pop and people are selling off risk on assets. So they're selling NASDAQ 100 stocks, they are selling Bitcoin, they're maybe even selling gold because gold also is not currently inflated. What are they going to buy with all of that cash? I think there is a case to be made that the US is still regarded as the safe haven, despite the high debt to GDP. There is, of course, the contrary popular story. For example, here, Andre Jig showing how China is currently buying a lot of gold and potentially tries to replace the US dollar. But once we actually take those numbers in perspective, the trend is much less worrying than this chart might imply. Because a kilogram of gold is currently $132,000. And so when China now holds 40,000 kilograms, then that's equal to $5.3 billion. Now, how does this number relate to the US Treasury holdings of China? So we've got 5.3 billion and China is holding 730 billion of treasuries. Yes, the balance over the years is declining, and this is even a more pronounced effect given that the monetary base expands by 6.8% per annum. So yes, China is reducing their exposure to US debt, but they're not replacing that all with gold. The gold purchases are way too small. Less than 1% of treasury bond holdings are now in gold. Probably you own more gold relative to bonds than China does. My impression is that this narrative is overblown, that China does not plan to replace the US dollar with gold reserves. China isn't even the largest holder of US government bonds. Japan is, followed by the United Kingdom. When we look at all foreign holdings, this actually went up recently. And yes, the holding of T-bills grew faster than the holdings of long-term government bonds, which is not a great trend. But in general, right, this is a very slow, gradual trend. It's not like the US dollar has suddenly stopped being the reserve currency. It's not like US bonds aren't getting purchased anymore. Maybe the relatively slow growth of US debt holding in foreign countries can just be explained by more and more investments into risk-on assets. Still, the market is very risk-on, right? Stocks, gold and Bitcoin, they're all at all-time highs. Really purchasing 5.3 billion worth of gold when the overall market cap is 28 trillion. It doesn't really move the needle for the gold price that much. So it's not China that pushed up the gold price. My impression is that it's again just retail demand, that it's just a common narrative. People just want to buy something risk off and they see the high valuation and so they moved into gold. The reason why buying US government bonds is such a contrarian bet is because everybody thinks that the US will deflate away their debt. But how are they going to do this without increasing the base money supply? It is very hard to find any asset class that's currently not historically overvalued. And maybe that's just an expression of how capital is concentrating more and more. Because what are we actually basing our valuations on? It's just how much is something worth, what's currently the market cap, relative to maybe the monetary base or relative to the cash flows it brings. Now, when cash flows aren't rising as quickly as valuations, then things tend to be expensive. Now, why do cash flows not rise as much? It's because the capital tends to concentrate towards the few winners that might use leverage to even increase their returns. And so maybe some of that leverage will unwind at some point. And people are looking for the next safe haven asset, and that might not be gold. Even China isn't buying that much gold. That safe haven asset might be at least partially US government bonds, which then in turn would push down the term or risk premium, combined with potentially accelerated interest rate reductions, because we all know how the employment data in the US also looks quite critical now, and the Federal Reserve does have the mandate to ensure not just price stability but also high employment. And so if interest rates come crashing down, if risk on assets delever, if people look for risk off assets, you've got two potential factors with the risk premium and the declining interest rates that could push up the price of long-term government bonds, especially the levered ones like TMF. And this is maybe where the real opportunity lies. This is the contrarian bet. This is the thing that very few people will agree with. But that's in the nature of contrarian bets, right? Nobody wanted to buy Bitcoin when it was at 16K and then afterwards it rallied all the way to 120K. Whatever purchase we do never feels good at the time when prices are depressed. It always feels bad because the momentum is currently against us. But usually the investments that don't feel great are the ones that pay off the most. And so I am going to buy some TMF. Will that bet play out? Who knows? But there's clearly a lack of alternatives. And I already own more than enough of those alternatives. If you got some value out of this video, if you got a different perspective here, then feel free to give this a like. It will help the channel grow. Feel free to also subscribe. I publish videos regularly. Feel free to also check out the premium membership. The link is over here. It pops up on the screen. I share my own trades, my own portfolio over there. So feel free to check it out. See you next time on YouTube or see you on Premium. Cheers.